Hi, Steve Sosnick here with today's Interactive Brokers Morning Market Morsel for February 11th, 2019. The trend that I'm going to call faux momentum continues today. We've got the markets a little bit higher as we're recording this. They did open strongly higher, about 10 points on the SPOOs, and then sort of fell off. It wasn't really clear why we were up in the first place. It wasn't really clear why we were able to salvage an up day on Friday in the last 5 minutes after a down day the rest of the day. But again, I think that's why I keep going back to this FOMO discussion, fear of missing out. You've got strongly rising markets, at least for the first 5 weeks of the year. For the beginning of the year, we're talking, call it up 10% on average. If you're an institutional portfolio manager, you don't want to be the guy who's underinvested. You don't want to be the guy underperforming. You don't want to be the guy missing your benchmarks because you're not going to get paid. And I think people see that, oh no, I'm behind the eight ball this quickly. I've really got to catch up. And I think that's why you continue to see this underlying bid in the market, despite the fact that it's not really clear to me what the real grounds for enthusiasm are. Yes, the Fed has become a lot more friendly in the last 6 weeks, let's say. That is meaningful, and that definitely did provide a good reason for the market to rally from the oversold lows that we saw at the end of 2018. I get that, and I'm a big believer in that. We were oversold, and there was a sea change in the largest single input to the markets, which is the Fed and monetary policy. The Fed is certainly friendlier, certainly more market sensitive than people thought they were only a few weeks ago, and that is providing some basis for the enthusiasm. But going forward, the markets also have to look forward. What are they looking forward to? Well, all the news over the weekend and this morning are that the government shutdown talks don't seem to be going particularly well. Maybe both sides will, find some commonality and realize that another shutdown is just colossally stupid. But that was the hope the last time, and that didn't work out. And so we'll have to see where that takes us. And I think there's some vague hope that something is going to be arranged on the China trade front, and it's not clear to me why that would be the case. And if it were, I don't think you'd be seeing oil getting hit again today the way it is. So what this leads me to believe is that you might want to start thinking a bit more defensively than you have been. It was really all systems go for the first few weeks of the year as you had this momentum-driven rally. Now you have to start to think, okay, earnings season is largely behind us. You did have some positive surprises in earnings season. What you're going to start to see now is instead of stocks moving in each direction, I think correlations start to converge a bit because you don't have as much stock-specific news. And that leads to a different type of trading. I think it's going to be more macro-driven. And so if it's more macro-driven and you've got these economic concerns and political concerns, I think it's the kind of thing that if you've made money, that's wonderful, and I think it was opportune to take advantage of an oversold market. But maybe you want to start thinking about how much risk do you have on, what sort of speculation are you engaged in, and whether or not it's appropriate to be thinking a bit more conservatively as we're going to get into a little bit more of a rocky season potentially. Thanks. Bye.